As promised to one of our subscribers, Mr. Ravi Ranjan Singh, hello and welcome to this video on the US derivatives market. In this video, we will answer some basic questions about derivatives, such as what they are, how they work, and why they are important for the US economy. So, what are derivatives? Derivatives are financial contracts that derive their value from an underlying asset, such as a stock, a bond, a commodity, or a currency. For example, a stock option is a derivative that gives the buyer the right to buy or sell a certain stock at a specified price and time. The value of the option depends on the price of the stock. Derivatives can be used for different purposes, such as hedging, speculation, or arbitrage. Hedging is when an investor uses derivatives to reduce the risk of losing money from an adverse price movement in the underlying asset. For example, a farmer can use a futures contract to lock in the price of his crop before harvesting it. This way, he can protect himself from the risk of falling prices in the market. Speculation is when an investor uses derivatives to bet on the future price movement of the underlying asset. For example, a trader can use a call option to profit from an expected rise in the price of a stock. This way, he can leverage his investment and potentially earn more money than buying the stock outright. Arbitrage is when an investor uses derivatives to exploit price differences between different markets or instruments. For example, an arbitrager can use a swap contract to exchange fixed interest payments for floating interest payments with another party. This way, he can take advantage of different interest rates and earn a risk-free profit. The U.S. derivatives market is one of the largest and most liquid markets in the world. According to the Bank for International Settlements, the notional amount of outstanding derivatives contracts in the U.S. was about $216 trillion at the end of 2020. That's more than 10 times the size of the U.S. gross domestic product. The U.S. derivatives market plays a vital role in the functioning and stability of the U.S. economy. It allows investors and businesses to manage their risks, diversify their portfolios, and access cheaper financing. It also facilitates price discovery, market efficiency, and innovation. However, the U.S. derivatives market also poses some challenges and risks. Some of these include: 1. Complexity. Derivatives can be very complex and difficult to understand and value. 1. This can lead to mispricing, mismanagement, or misuse of derivatives by investors or intermediaries. 2. Leverage. Derivatives can amplify the gains or losses of investors by allowing them to control large amounts of underlying assets with relatively small amounts of money. 2. This can create excessive leverage and volatility in the market. 3. Counterparty risk. Derivatives involve contractual obligations between two or more parties. 3. If one party fails to fulfill its obligations due to default or insolvency, this can cause losses or disruptions for the other party or parties. 4. Systemic risk. Derivatives can create interconnections and dependencies among different financial institutions and markets. 4. If one institution or market experiences a shock or failure due to derivatives exposure, this can trigger a chain reaction or contagion that affects other institutions or markets. To address these challenges and risks, the U.S. government and regulators have implemented various laws and rules to oversee and regulate the U.S. derivatives market. Some of these include: 1. The Dodd-Frank Act. This act was passed in 2010 after the global financial crisis of 2008-2009. 1. It aimed to reform and strengthen the regulation of the U.S. financial system, including the derivatives market. 1. It introduced new requirements for clearing, reporting, trading, and supervision of derivatives transactions and participants. 2. The Commodity Futures Trading Commission, CFTC. This is an independent federal agency that regulates the U.S. futures and options markets. 2. It oversees the registration, compliance, enforcement, and education of derivatives exchanges, clearinghouses, intermediaries, and users. 3. The Securities and Exchange Commission, SEC. This is an independent federal agency that regulates the U.S. securities markets. 3. It oversees the registration, disclosure, enforcement, and education of securities exchanges, broker-dealers, investment advisors, and issuers. In conclusion, derivatives are financial contracts that derive their value from an underlying asset. They can be used for hedging, speculation, or arbitrage purposes. The U.S. derivatives market is one of the largest and most liquid markets in the world. It plays a vital role in the functioning and stability of the U.S. economy. Thanks for watching this video. Please subscribe and like, and do let us know your comments or if you have any suggestions.